Hey guys, Bryan Lebo here with another special segment related to the effects of COVID-19 on our housing market. Now, in the last video, I explained what happened and how the housing market could go from bad to worse. Now, if you haven't seen that video, I'll be sure that there's a link below in the description. Now, I stated in that video that the severity will be predicated by the government's intervention and the overall duration of the virus. In today's video, I'm going to cover what the government has done specific to housing and how lending has been affected by that. The main emphasis here is on how these loan forbearances may greatly damage our ability to recover post-quarantine. Okay, now one of the major housing benefits of the CARES Act that passed on March 21st included the option for mortgage forbearance. Now, on one hand, this was wonderful news for millions of Americans that are currently unable to make this month's mortgage. So this was a huge short-term lifeline. On the other hand, this has created a massive long-term problem, and the government still hasn't provided any direction with regards to how they plan on handling this. Imagine if Hoover Dam were cracking all over the place, and the government just slapped a thin layer of concrete over it. Yes, it stops the immediate fractures and leaks, but it did nothing to stop the actual problem. In fact, the structural problem still exists, and now, instead of cracking, the whole dam itself might just explode. Now, to explain this phenomenon, we first have to understand what a forbearance is, and more importantly, how mortgages really work. So let's start with forbearance. Simply put, a forbearance isn't a forgiveness of debt, as many people are assuming. It's rather a temporary postponement of mortgage payments. That's it. The CARES Act only applies to federally backed mortgages and allows for 6 months of skipped payments. Now again, this applies to federally backed mortgages. Any jumbo loan, investor loan, or loans like stated income loans are not federally backed. And therefore, it's up to those servicers and investors of those mortgages to decide for themselves. Now, on the surface, this sounds wonderful for people. Many borrowers simply can't afford to pay their mortgage right now, so this allows people to stay in their homes and protects them against any negative reports on their credit as a result. But here's where things get really messy. To understand what I'm about to tell you, you also need to understand how mortgages work. So here goes a very basic explanation. When you first get a mortgage, the bank that initially lent you the money typically bundles your loan along with about 1,000 other loans of similar characteristics and profiles. Now, that bundle of loans are graded and then sold on Wall Street as what's called an MBS, or mortgage-backed security. Now, investors like pension funds may own these mortgages, but someone has to be the middleman to collect your mortgage payment. Then, the servicers forward that mortgage payment along with the other 1,000 of them to the investor that owns them. This middleman is called the servicer. The top 5 servicers in the U.S. are Quicken, TD Bank, Huntington National Bank, Regions Mortgage, and SunTrust. So the odds are that the bank you write the check to every month isn't actually the institution that owns your loan. Very important to realize that next time you're pissed off at Wells Fargo or B of A. Now, what most people don't realize is that if you don't pay your servicer, that servicer still has to pay the investor every month. Their job is to figure out how to get that money back from you so they aren't out that money. See where I'm going now? Well, right now the fear on Wall Street is that if 20% of Americans take that forbearance, then these loan servicers will essentially go bankrupt. Now, the guy in charge here isn't the Treasury Secretary Steven Mnuchin, but rather Mark Calabria, who is in charge of the Federal Housing Finance Agency, FHFA. Wall Street's freaking out because many servicers essentially can't go 6 months without income from these mortgage payments. There's a massive fear that if servicers fail, the housing industry will collapse. Now, his reply to this conundrum is simply, nothing we are seeing as of today suggests that this is a systemic problem. In short, he's willing to just let servicers fail, and if that happens, he'll simply have the loans moved to a different servicer, effectively saying, hey buddy, don't look here for help. Now, why should we care about all of this? Okay, let's get back to our reality for a second. I've personally reached out to some of my mortgage servicers, my family has, and so have several of my clients and friends. Most servicers are very accommodating right now. You basically click on a button and magic. No payments for 90 days, with another 90-day extension in the wind. However, some, like Flagstar for example, is kind of unwilling to speak to anyone for assistance. So far, they appear to be completely unaccommodating. They've been telling people for 2 weeks that they'll be in touch within 3 to 5 days and never do. So let's say that you have an accommodating servicer who allows you to skip 6 months of payments. Sounds great, right? Well, consider this. Let's just say your mortgage payment is $1,500 a month. If you miss 6 payments, what is that, 6? That's $9,000. Well, as I explained earlier, the servicer is out $9,000 to that investor. Now they need to find a way to get that money back from you. So what people don't realize is that after 6 months of missed payments, your servicer is going to come back to you and say, hey, now you owe us $9,000. How are we going to get this back? If you ask your servicer right now what happens in 6 months, they'll pretty much refuse to answer that question directly. All servicers are saying right now is that we'll have that discussion then. Well, unless the government steps in, the answer is going to be, you owe us $9,000, buddy. So just pay us, say, $2,000 next month instead of $1,500 for, say, the next year and a half. So while you manage to avoid payments now, you're essentially creating a larger problem down the line. Now, what everyone is hoping for is that these servicers will say, hey, don't worry about that $9,000. We'll just add that to your principal balance and extend the term of your loan to 6 years or 6 more months on the back end of it. Well, this is what everyone's hoping for, and it seems the most logical solution. Unfortunately, this is not going to happen without government intervention. What people fail to understand is this. Your loan isn't that simple to modify. By changing just one part of your loan, you're also affecting the entire financial instrument of that entire mortgage-backed security itself. Bottom line, this is incredibly unlikely to occur. So unless the federal government announces funding to servicers to cover these forbearance payments, we're going to end up with some servicers going bankrupt and millions of American homeowners finding themselves in default. I mean, look, especially for Las Vegas, many people here are going to find themselves either without jobs for an extended period of time or simply with reduced pay at their job. With reduced or no pay, it's going to be quite difficult for borrowers to make larger mortgage payments come October. Now, the second part I wanted to cover has to do with lending. Since these lenders are concerned about defaults, as I just explained to you, the entire industry has vastly tightened up lending standards. Here's a few examples. First, there's pretty much no stated income loans right now for self-employed borrowers. Next, Flagstar, who earlier I mentioned has been working with pretty much no faith on these forbearances, completely dumped jumbo and construction loans. No mas, done. Even on a VA or FHA loan, they now want a minimum 640 credit score, which just used to be 580 a few weeks ago. Wells Fargo and US Bank followed suit, but they upped the ante to 680 credit score. Then you got Chase, who said the minimum is 700 credit score, and you need a minimum of 20% down before they'll lend. Navy Federal Credit Union stopped all FHA loans altogether for the rest of the entire year. Wells Fargo came out and stopped all jumbo refinances unless you're a Wells Fargo customer with at least $250,000 in their bank. Last but not least, Fannie and Freddie now require income documents only from the past 60 days. They don't care what you were making before all this. They want to know where you're at right now. Even employment verifications are now being done at the day of closing instead of normally earlier in the process, just to ensure that the borrower is still employed. So basically, it's back to like 2008 here for a while. If you can prove why you don't need a loan, they'll give you a loan. Now that's a joke, but not really. Now to end this video, the good news is that it looks as though there's a lot of positive signs that this pandemic will not last as long as we originally thought. It's great that the government has stepped in and attempted to provide aid to small businesses and homeowners. But as you just saw, with every answer and offer of aid, we seem to have more questions on the back end of it. Since every week tends to bring something new, I'll be sure to keep pumping these videos out and keeping you guys informed. Thank you again for watching. Please be sure to subscribe, and please share these videos with your friends and family and people in your circle. Be safe and try to enjoy all this downtime with your family. See you guys again soon.